So tonight we're going to bring up, I'm telling you, it's a real person. I know him well. We started here. He will tell you his story. He will tell you he sat in the exact same seats that you're sitting in. So with that, I'm going to bring up Mr. Chris Peavy. Great guy. Come on up. All right, Mr. Peavy, tell us a little bit about yourself.
All right. I have a degree in engineering from a small school in northern Michigan. I worked for an oil and gas industry. And come 2015, who in here works for oil and gas?
Couple people.
Who worked in oil and gas in 2015? Who knows what happened? Yep. I watched a lot of my employees get laid off, and then I joined Lifestyles. And when I joined Lifestyles, I knew I wanted to take a step. So myself and another investor, same here, sitting right here with y'all, bought an IRO deal. I work for a service company, and you that work for oil and gas companies know what happened to service companies before oil and gas. Everybody gets laid off. So I joined, bought an IRO deal, apartment complex, 54 units. So I hedged my bet. I was not worried about basically being laid off, because I had cash flow from this deal. I joined 6 months later, bought a deal, and kept going. Like Dale was saying, fearful of the ultimate, being laid off. My wife, though, works for Walgreens up until about a month ago. She retired. She still works as a 1099 for another company, but she doesn't necessarily have to work.
And that's the beauty. A lot of us will retire our spouses or will retire, and we kind of get to choose what we want to do as our next aspect in life, right? I'm not a big person as far as you retire and you do nothing and you sit on the couch and do nothing all day. You've got to do something. So a lot of people will actually become leads and they'll get the real estate bug. They like what they're doing, and that's kind of their next life right after that, right? But they enjoy what they're doing.
Yeah, exactly. Retirement is doing what you want to do, right? I am not retired by any means. I work for investors, and that's how I earn a living now.
Did you go over the passive part of that, David? We call it the lifestyle they talk about. The lifestyle is not becoming a lead investor operating properties. Okay, that's work, and he gets paid to work, right? Passive and the true lifestyle is when you invest with all these other leads and they start paying you quarterly dividends, which is happening quite relevant here in lifestyles lately. And that's when you're retired. And you go do what you want because you know there's income coming in, whether you're working or whether you're traveling or whatever you're doing. So that's the true lifestyles we're talking about.
Yeah, I have 9 employees. Do you think I am retired? Absolutely not. Like I said, so my wife is a pharmacy manager for Walgreens for a number of years. She has since retired, works 1099 from the house, thankfully, pretty nice. I am a native Houstonian. I have 2 children, 2 boys, 8 and 5. And I joined Lifestyle sitting right here, like y'all, almost 6 years ago now, or more than 6 years ago.
Very good. Very good. All
right. What did Lifestyles, or why did I join Lifestyles? Learn how to replace my earned income with passive income and eventually retire early. Like I said, I am by no means close to that, but I am getting a lot closer. And I mentioned before, protection from the volatility of market of the oil and gas industry. Benefit from mentorship and gain access to valuable real estate investing resources. What do I mean by that? Look, if y'all having a bad day at a property and you have an issue and you can't figure it out, I got a Rolodex full of phone numbers that I can just call and get an answer pretty quick. It's going to be short, it's going to be sweet, but it's going to be straight and to the point, right? And I think that's one of the absolute largest benefit to Lifestyles that I can absolutely bring. Like if you join Lifestyles and you don't use, you're doing yourself an injustice. So
yeah, we have I don't know if you went over this earlier or not, but the Lifestyle organization here, when you join, you're kind of joining a family, and we truly share everything, anything and everything. So if there's a problem you're having or you have a question, you call the mentors, you call the operational consultants, you call your friends that you've met sitting in the exact same seats that you're sitting in, and it's just it's just crazy how it works. But basically, we share with each other every little thing. So there's no problem or no incident that he is ever going to have that he cannot pick up the phone and call someone who's had that exact same experience. Things like, here, this is exactly what you do. And we do. We share among each other. So the mentors are here. We share that as well. We will direct you, but the mentors don't know it all. We'll be like, oh, crap, that guy had this problem. You need to call him. He had the exact same fire, 20 units destroyed, and this is what he did. Call him. He'll tell you exactly what to do. And that's the beauty of what we're doing here. So
Yeah, and one more thing, a little bit deeper on this, people, because I always bring this up during my seminar the weekend, is look at the outside world compared to this. It sounds crazy, this abundance mentality, because if this guy owns an Exxon and this guy owns a Valero, are they sharing their information? They see each other as competitors, but he's willing to open his books and say, this is what I pay for my maintenance man. This is what I pay for my supplies. Is that not cool? So that's what he's really talking about. It's even a level deeper than that. We don't see each other as competitors.
right, we don't. And I will venture to guess 99.9% of us would never be doing what we're doing today, me included, if it hadn't been for the people before us that helped me and helped Chris. I mean, we're literally like just, here's what you do, here's what you do, here's what you do. So very good.
Yeah, and exactly. It's not just necessarily helping each other, but it's pushing each other. If I start, if I am, yes, Lee is one of my mentors, but if I start doing something, I give him ideas as well, and we push each other together as a team. So it's really good.
Exactly. Very good. All right, so what are we talking about tonight?
All right, so this is one of the deals I acquired, almost 2 years ago, a little over 2 years ago. It's a 178U property in Kingwood, Texas, northeast Houston here. Its property name is Trailwood Village Apartments, if any of you are familiar with the area. Purchased it in 2019 for $16 million. Which is approximately $90 a door. You'll hear a lot of the rhetoric on talking on a per door, expenses per door, income per door, sale price per door. You will see that as you go, and even in the 2-day they'll talk about that. It was acquired on an existing loan assumption. There's multiple ways to acquire property, and a lot of times it's either new debt or existing debt. Because they securitize this debt on a long-term basis. And to move, $12 million over a short time span is difficult. So what they do is they have large backers, banks, private investors that buy this on bonds, and they don't want you to sell out. So sometimes the best way to acquire a property is to assume that debt because it's already been secured.
And I think David will go after this, the different mechanisms for financing properties this weekend. There's recourse debt, non-recourse debt, all that he will go into.
Yeah, so you heard what they said was a bunch of gibberish if you're new.
Yeah.
I will break it down to a 3rd grade level so even Aggies will understand it. So I'll make it much simpler in the seminar. These guys are just a little bit more advanced, that's all.
Dude, aren't you an Aggie?
Absolutely not.
Okay. Very good.
So total cash out of pocket on this deal was $6.75 million. I have about 110 investors in this deal, anywhere between 25,000 all the way up to 200,000.
And are all those investors local or?
No, I have nationwide. I mean, a couple in Hawaii. I got some in.
Another question, follow up.
Yep.
How many of those 110 investors actually came out there physically and walked that property? Do you think?
5.
So, and the reason I bring this up is the people watching from Hawaii or California, they don't. It's like a mutual fund. You invest in it, you get great rates of returns. You don't have to actually physically be there. And like he said, the lowest investor was what, 25K? So that's regular folks. Give them a hand for helping the truck driver, the little guy out too. And that's huge, not just rich people. So it doesn't matter if you put in 25K or you put in 100K, a rate of return is a rate of return. So if you make 10% a year, you make 10% a year. Everybody with me? You double your money, you double your money. Everybody does the same.
Very good.
Initial financing on this deal was $12 million. I assumed the 9.82% that the current owner had, and then I added what's called a supplemental, basically to right size the debt to get a better leverage. When you typically go out and buy a house, you're trying to get 80% LTV, loan to value. Well, this is typically on commercial deals, you're going to 75% LTV. Rarely you'll get to 80, but most of the times it's 75. So basically what I was doing is I was right sizing my debt. And what I got here was a blended rate. The original debt was about 4.08%. Then the supplemental's higher. So the blended rate all in is 4.29. I rehab in the budget is 1.8 million. You'll see David talks about, getting rehab in the loan. This one is not that case. We brought all of the money to do the rehab out of pocket. So,
very good. So to recap, you bought 178 units for $16 million. You brought in cash with investors of 6.75, and you financed $12 million of that. And included in that rehab budget, oh no, not included, but you also raised as part of that 6.75 was 1.7 to do the rehab.
Correct.
Everybody got that? Very good. All right.
All right. So the current income in this deal on a per month basis is currently $234,000. Expenses are 117, give or take, which gives us an NOI of 117,000.
And NOI means net operating income, and David's going to go over that this weekend. But the way you value apartment complexes is based on your net operating income. That is the way you evaluate it. It's not like a single family home where you look at comps in the area and this house sold for 100,000, this house sold for 80,000, the average is 90,000. That's not the way it works. In the apartment business, in multifamily, the net operating income is what is the golden child, all right? That is what values the apartment. If the net operating income goes up, the value of your property does what? If it goes down, what happens to the value of your property? Very good.
Monthly cash flow after debt service and reserves, about 52,000. Cash on cash returns about 9.3%. Total to date distributed is about 550,000. Current valuation is close to about 25 million.
Very good. Awesome. So he's telling me he's generating about 50 grand a month in cash flow, right? And he's sending out about 9% a year in what we call cash on cash, meaning that $6 million, $6.7 million that he raised. Those investors, based on their equal ratio, whatever they invested, they're getting about 9% on that return per year. Is anybody getting 9% on their bank account right now? Is anybody getting 2% on their bank account right now, right?
0.09.
Right, 09. 09. There you go. Awesome. All right, and again, to date, he's distributed over $500,000 on this asset that he's bought 2 years ago. Very good. And then the current valuation is basically $25 million, and we're going to get to that in just a second. But what did he buy it at? $16 million, and now it's worth $25 2 years later? It's pretty impressive. And that's all based on the what? Net operating income. He was able to raise it. Very good. All right,
so here's some before and after shots of the front of the office. It looked really good, right? I mean, so if y'all aren't familiar with this area, I would say it's an A-class area it was being operated as a C-class property. Now it's being operated as a B+. It's in a very good location. It's literally neighbors' properties with an elementary school and a very good school district, and it's next to 2 churches. Every property that I've owned that's next to a school is like shooting fish in a barrel. Like, you get high rents, high occupancy, end of story.
all right, very good. So just like I want to explain what he's going through here, before and after, he's talking about construction, right? Upgrading the unit, just like single family where you go in, you fix everything up front. We typically do the same thing on the multifamily. We go in and we give it a paint job, we replace rotten wood if there's any sewer problems, bad tenants, they're not tenants, what are they called now? Residents, I'm sorry, they're called residents. Kick out the not-so-existing residents that aren't paying, okay? And we don't discriminate. We only discriminate based on if a resident is paying or not paying. That's our only discrimination we do. If they're not paying, we throw them out, and we bring in people that do pay, okay? That's part of your upgrade rehab, just like the single family. So, go ahead.
So this is just a curb appeal outside the office. Next picture is before and after of the same exact pool area, just different angle. We did a full exterior paint, wood rot repair, replaced all the windows and doors. Did a ton of rehab on this property. Here's same exact courtyard, different angle. You see that there's 2 pools on this property. We added a gazebo with a grilling station just to try to add more amenities and try to drive interest to the property. Office before and after. Modern look.
Modern look, right?
Same model unit attached to the office. Bedroom before and after.
You just put lights in it or what?
Photoshop. Here's where we begin a big bang for our buck here. You can see the difference, right? We refaced the cabinets. We've done granite, tile backsplash. Yeah, we're adding an expense on the front end, but the value we add when we're going up $300 a month in rent is tremendous, especially when you're buying it at a 5.5 cap.
Right.
Now selling at 4.5 cap. David will go all over this.
How many people?
What I want you to remember from what he just said, when you come to my seminar this weekend, guys, he was able to raise the rents how much on a unit?
$300.
$300. That's like peeing your pants exciting. I know you don't know the numbers now, but this weekend, when I teach you math on Sunday, you'll say, holy beagle turds, because I can't say that word. But yeah, it's very exciting. You just don't realize that. Math is exciting. Who's with me?
That's not exciting. All right, so the other thing I want to point out here is also people who buy houses, right? When you go in to buy a house or you go in to rent a house or rent even an apartment, what sells it is the kitchens and baths, right? How many ladies agree with me? Kitchens and baths are kind of what sells it. So when we go into upgrade, we're upgrading kitchens, and I don't mean to be sexist. I apologize. So we have kitchens and baths. So when he's upgrading kitchens, he's upgrading baths.
Absolutely.
The main rooms are a paint job and carpet or flooring. That's all you're really doing. But what sells it and where you're able to increase the rents are on the kitchens and baths. So when you do your rehab, put the money in there. Okay.
Unless there's a pole in the living room. What does that mean? That means they were firefighters. Why would they answer?
A party.
You lie. I went to a due diligence. We walked the units, and there was a fucking pole in the middle of it. It was hilarious. Hilarious. All right. Oh, I'm sorry. You got to edit that out. We do have a time delay. I apologize to Zach's kids that are in the room already. I apologize. All right. All right. So let's talk about cash-on-cash returns and investing. So what have you done the first year, second year, and you're on your third year right now, correct?
Going into third year, correct.
Very good. All right.
Year one, these are actual numbers, income, rents, laundry, everything. Total income down the bottom line is 2.163. Operating expenses were at about 1.153. The net operating income is just over $1 million. With mortgage and capex, you're at about $500,000, and the net cash flow $400,000, which is about a 6% cash-on-cash return. Year two, we increased. So we bought this property in 2019, 2020. Everyone knows COVID took effect. So we didn't ramp up income as hard as we probably could have because we wanted to maintain occupancy. So when you're going through a rehab, there's things that happen. Same with when you buy a single family home, you typically buy it, you're going to rehab it. Well, nobody's staying in that rehabbed house while you're rehabbing it. Well, you can't increase rents right out of the gate. So you got to wait till these turn. Well, a lot of times when you're going through these capital expenditure projects, upgrading paint, exterior, there's people that just don't like change and would rather live in a slum. So they end up leaving. So your occupancy is going to drop. Well, imagine doing that and then with COVID. So that was fun.
But your income still increased during COVID. Everybody get that?
Correct.
That's awesome. All right.
Yeah, well,
Yep.
most businesses were going out. He's still making money.
Yep.
Okay. So go ahead.
Yeah. So, second year we generated 2.54. So we increased income by $400,000. Operating expenses went up primarily because of taxes and insurance, and then some turn costs. Net NOI after that was about 1.148. Mortgage capex because, like I said before, this debt was assumed. The IO period expired.
IO meaning interest only.
Interest only.
You had debt that was interest only the first couple of years, and then the principal starts kicking in year 3 that he buys.
Yeah, they gave him a little bit of a leeway because they know it's a fixer-upper. It's going to take time to turn it over, so that's why bankers are a little nicer to him.
Correct. So net cash flow was 468. Cash and cash return 6.9. This next year we're going to start to see significance. We're in a really good position. We're projecting income to be about 2.8 million. Operating expenses to be about 1.4. Like I said, taxes and insurance, there's things you're going to pay in life, right? Taxes are inevitable.
And you would consider these numbers, you're definitely being conservative on the conservative side, right?
Yep.
See, that's one thing we love about our students and our mentors. We stress test their numbers. We're very conservative. What does that mean? Under promise, over deliver. Who likes that idea? That's how we do all our numbers.
I also want to point out the cash-on-cash return, again, the 6%, 8%, that's off your original investment. So even if you invested $200,000, if you invested $25,000, you're still going to be getting 6 to 8%. And y'all might not sound too sexy, right? But that is 6-7 times what they're getting in their bank account right now, right?
And it's tax-free.
And it's tax-free, okay? Deferred, it's free, okay. But here is where when you buy a single family house, they talked about cash flow, and then when you sell it, you have that capital appreciation, right? What did we discuss on what drives the value of an apartment complex? The NOI. Have you noticed that the NOI has started going up, right? So let's see what that has to do with the actual value of the property. So explain
Yep.
this thing? Go ahead.
Hmm?
Go ahead.
Okay, so purchase NOI, I actually went back and looked. The NOI was at about 918,000. Year one, we did hit 1.01. Property value, because obviously, the cap rate started to compress a little, which drove the value. Not only with the value of the NOI going up, you have the cap rate compression, which increased value, and we had also dumped about $1.5 million into the deal, which you ultimately get with a higher NOI, higher income, lower expenses. We didn't have any debt payoff, cash and cash contributions in the first year. We're at about 150. Total equity captured was about 3 million.
Okay, so I want to make sure you guys, David's going to go over that this weekend, but the valuation is net operating income divided by what we call a cap rate, okay? And the cap rate, he will discuss this weekend, all right? It's a very technical term, but it's a percentage, right? You divide it by a cap rate of the current existing, and that's how you get the property value, right? So if cap rates go down, the property value goes up. If cap rates go up, the property value goes down. But as a whole, they typically track interest rates. Typically in the past, they probably are not going in the future. I don't know. But anyway, if you draw everything constant, if net income goes up, net operating income goes up, cap rates stay the same, the value of your property goes up. Y'all get that? So we're keeping cap rates exactly the same as where they were when he bought it. Okay, so we have consistency. So just by driving net operating income up, the value of his property in year one has gone up by $3 million. In year two, cumulative $8 million. In year three, we're estimating about $9 million going up. All right, and all that is doing is increasing net operating income, which is increasing revenue, decreasing costs, or keeping costs in check, right? And then, so $9 million in 3 years, that's an additional 133% capital gain over his original investment for the initial $6.75 million that were invested. Everybody understand that? Okay?
So I'll explain it to an Aggie.
Okay.
You're an Aggie, right?
No.
No? Oh, okay. I thought you might.
He's disavowed
Sorry
Aggies
to
3
disappoint
times
you.
now.
Oh, I know. I heard it. It was funny. So let's say you put 100 grand in, because that's a round number. You got back your 100 grand. You're made whole. And then you make another 133,000 on top of that. Who'd be okay with that? But wait, there's more. If you act now, you also will get the ShamWow and the Snuggie. No, the point is you also are getting this cash flow as well on top of that. Everybody with me on that? And that's all tax-free as well. Does that sound like a pretty good deal? Give him a hand, because you see how excited he is.
That's awesome.
Engineers, they get excited about this stuff.
Yeah, really excited.
Now, do y'all
Just jumping up and down, right?
Y'all understand $9 million, right? It's not like the single family where you're talking about a couple $100,000, a couple thousand, a couple $100 or a couple thousand. We're talking $9 million valuation in 3 years. That's powerful. And how did you obtain that? I'm going to tell you, he bought the property.
Yep.
Right? You've got to buy, right? And you buy a single family, buy a small multifamily, buy a bigger property. It doesn't matter. You have to buy. If you buy, then you're going to do well.
Yeah, I mean, when I was sitting right here, and I joined, and I think my wife thought I was crazy. I mean, she's sitting over here now. She just snuck in the back door.
Welcome.
But within 6 months, I bought my first property, and it wasn't a house, right? I had a full-time job at the time, and my wife had a full-time job, so we partnered up with another group that was in the same 2-day, and we bought a 54-unit property, right? So we could afford.
That's scary as shit, isn't it? The first time you do that?
That's
Yeah, it's scary.
that's another industry standard word.
Oh, sorry. Yeah.
It's okay.
Very scary. Very scary. It doesn't matter if you're buying your own first, even a single family house. If your first time, it's scary. 45 units.
That was
50
full
units,
recourse.
200. Yeah, full recourse, meaning he's on the line if something
It's like
goes
buying
wrong.
a house, right? I
Exactly.
mean, now when you buy these deals, it's what's called non-recourse, right? They don't come after you personally.
Right.
They're underwriting the business, right? So they'll just take it back from you. You don't
And-
get your money back.
And another big powerful thing is it's great to buy houses when you don't have a lot of money to work with. You'll make 50, 60 grand a year, which is great. But if you want to make large numbers, you have to use large numbers. If you have more money to deploy, because as you start doubling, well, now I got to invest 400,000. Well, you can't do that with houses. But yeah, I can put 50K in like 8 deals like this, have them all double for me while I do nothing. Everybody with it? So there's one last thing I have to ask. You're doing all the work. You're running this property. You're doing that. You have all your staff working for you. You have investors in these deals, right?
Absolutely.
Could you explain to the new people in the room, the investors invest with you, how much work are they doing on the deal? Those 100 investors, what are they doing?
Nothing on the deal.
They're doing something.
Yeah, they're
What do they got to do?
reviewing
Go through it. What do they got to do? They got to read a
reviewing
report?
emails, file their K1s with their accountants that I.
Cash or checks.
Yeah.
Does that sound
Cash or
easy?
check.
Going out to your mailbox, getting a check once a quarter, double your money, not doing crap. Who likes that idea? Because that's what the past. I want to make sure the new people understand that.
Is crap a French word too?
Well, yeah, I
Okay,
said.
just checking. All right, go ahead. Very good. That's awesome. All right, so how did you achieve this?
All right, how did I achieve this? Income and expenses. The expenses on this property were honestly pretty wild. I was able to increase or decrease the expenses on just the electric, water, gas, and by about 40%, and that's no joke. And it was through full water conservation, electrical conservation, changing about 90% of the ACs. Did about
So you notice he is one of those green hippies that cares about the environment.
hey, look, okay, so with this property, it's an all bills paid, master metered property.
Yeah.
It's hard to raise rent on properties like this if you're charged, if the resident's getting a big bill on electricity every month. So if we can reduce the rent, the utility income, the other income basically, and then it's easier to grab the rental income, right? Because if you're reducing this line, you can grab the rental income. The reason why that's important, what do banks really look at? They look at gross potential rent and net rental income. They don't look at your total net income. So
They look
that's
at
where the true
income, they
value
look at
is.
pro forma, they look at your rent roll to see how much rent you're currently getting for the last 5, 10 tenants that came in. And if those 5, 10 tenants are a lot more than those people, what do they think the next 20 are going to be? They're going to be even more, right? That's what the banks are underwriting at. They're looking at your gross potential. And again, David's going to go over that this weekend, what all these terms mean. But we're looking at income and potential income. What potential people can pay for it, right? That's what we're looking at.
Yep.
Okay.
And then driving up the income about 15%, just with all the upgrades that we've been doing. So
increasing income, decreasing expenses does what to your NOI? It
Up.
goes up. What happens when your NOI goes up?
more value.
What happens when your property value goes up? You make more freaking money. Come on, guys. All right, very good. All right, so how's lifestyle changed your life, man?
We pretty much alluded to this already. Learned about financial freedom from investing in real estate. Showcased and guided me through how to successfully operate profitable multifamily real estate, and it provided means to early retirement and ultimately set up my wife and I for long-term financial success that one day we can pass down to our children.
Very cool.
So she doesn't have to work at Walgreens anymore.
Unless she wants to.
What choice?
Unless she wants to.
That's your wife right there, right? Yep. So you're a pharmacist. What crops do you farm?
I used to say that she was a drug dealer at the corner of Happy and Healthy.
There you go.
People would look at me funny, but I said, think about it for a second.
Yeah. Not street level pharmaceuticals, right? Okay.
I thought that was a property amenity,
Sophisticated
actually.
ones.
All right, so what are your goals going forward?
Purchase more multifamily properties. It's a short-term. Long-term goal, obviously spend more time with family. Invest passively. That's like we're here, the ultimate goal. And then set up my wife and I for early retirement, leave behind a legacy for our children.
Very cool. Very cool. Nice goals. So who's on your team? Did y'all talk about teams? We talked about that yet? Yeah or
Go
no?
ahead.
No, I'm asking you if you have.
I did it in a single family a little
Okay.
bit. But you weren't here. You were out getting drunk with me.
I was not-
After 4 glasses of wine, the seminars get better, right?
I do.
Gotta loosen
So
up.
we alluded to a team altogether. So really the multifamily is truly a team.
Yeah.
I mean, you cannot do it without the realtors. You cannot do it without the peers or your mentors that have done it before you and telling you what to do. You can't do it without your contractors. You can't do it without your lender. It's truly a team. And getting that team together is part of the process in getting into multifamily. We help you put together that team. We introduce you to mentors. We introduce you to realtors. We introduce you to other people that, again, it was sitting in the same seats. You're going to meet people. You're going to meet peers. We have these things called multifamily road trips. You will come, you will sit there, but we'll go through stuff like this, but in immense detail. And you will sit next to people that are doing or have done what you want to be doing. And you sit down with them, you talk to them, you go to lunch with them, you go to happy hour with them, you go to after happy hour with them, you go to after? No, I'm just kidding. All right, but you put together your team, right? You meet these people and they become your core, and that's the team that you're going to go, and they're going to help you in every way. Purchase it. All right, so who's on your team?
Guardian Construction, they did all the construction of the property, exterior wise. LMI Capital, as you were saying that, obviously Randa, she's been awesome. I can reach out to her anytime.
Randa's our operations consultant. Give Randa a hand over there.
She's actually the consultant for the internationally. It's a huge now. Well, nationally now. She was just promoted because that's how good we are in here in Houston. So congrats.
Scott Van Osteren and Curtis Haynes also were mentors on this specific deal themselves. Like I said, Guardian Construction for the construction side, LMI Capital for the mortgage broker side. I got a couple attorneys involved. I mean, it's truly a team sport. Don't think you can do this on your own. That's for sure.
Oh, sure. Very good. All right. Any questions?
Before we get to questions, really quick. There's people new that are coming to my seminar for the first time. Remember back when you joined, not now. What advice would you give brand new people coming to the seminar?
Go, listen, and then join.
Okay.
Like, I'm not joking. Like, it's changed my life. I mean, I'm not a paid actor up here by any means.
Yeah, we would have hired somebody more exciting if it were.
Easy.
I tell people what they need to hear, not what they want to hear. I'm sorry.
I don't know. I mean, honestly, like you're doing yourself a disservice for not joining. I mean, this has been life changing for me. Full stop. I do not work corporate America. It's the best thing I've ever done. I've learned a whole new way of life on how to, I don't know, just live. I mean, I don't have a W-2 employee, right? I mean, I am not a W-2 employee. I have W-2 employees, right? So it's completely different.
Learn to control your time.
Exactly. Yeah. And I'm still learning. Still learning.
Yeah, we're all still learning. Yeah, absolutely.
Absolutely.
Cool. Okay, now we'll take the questions.
Do we have mics or no?
Yeah. I'll run them out there because you're lazy.
I'm not lazy.
Well, you retired earlier than me. You're younger. Tell them where you're from first off, David. You got to tell everybody.
Well, I'm from California.
Yay!
But I've been here for 4 years.
Yeah, I know.
Before you bought the property, you did your numbers. How did your numbers from the beginning till now, how did they line up? And from when you bought it, acquisition to where you are now, what's your exit strategy? Are you holding? Are you time stamped? Where are you on this?
They are very close on just a straight case by case basis, just looking numbers to numbers. I have not obviously distributed enough as kind of had I projected, but that's because I'm reinvesting some of this capital because the market's gotten a lot more aggressive with some of the upgrades. So I've been putting more money in, but that's how I'm getting this larger valuation is I'm increasing more income and investing in the asset long term. As far as what's the exit strategy on this deal, it is I did assume the debt, so it is 10-year debt. It was originated in 2016, so its exit is potentially going to be 2026. It is on what's called yield maintenance.
Yeah.
I don't know if you'll go.
Don't go into Ephesians, yield maintenance. I'll explain that later, guys.
So the prepayment penalty is very high until you get closer to the end of the term. So it will be a longer term hold. I am actually working on a refinance on this deal, but it's not a typical refinance getting new debt. It's just adding what's called supplemental debt to this deal.
So you can add another loan on top, pull money out, and give it back to the investors is what he's talking about in simple English.
In terms of the budgets and the forecasting, the way original investment was put together and what actually happens, is there anybody in here has done forecasting and budgeting in corporate America? Okay, if you have, you know that it's a bunch of crap, right? Everybody sits there and they go, this is the assumption. This is what upper management wants to achieve, and so these are the assumptions they use to achieve this. What we do is we put together our best assumptions to start with, right, based on what we know. Then we go through a due diligence period where we try to uncover every possible thing we can find about the property, and so we change our assumptions based on that, and then we buy the property, right? And we go through all of this in the multifamily education seminars, where you actually will truly learn some stuff. And when you actually get in and you buy the asset, you truly find out what it's like. How many people are married here in the room? A couple people, right? Remember what it was like to date, and then you got married, and you're like, holy, what the hell happened to that, right? It's not quite the same. You discover stuff after you truly purchase it, and then you make accommodations, and you still go forward. Does that make sense? So the budget numbers and the pro formas we put together are they're changing every day, but we're constantly looking at what happened the last quarter versus what's happening this quarter, and we're always trying to better that. Okay? Does that make sense? Okay. Sorry.
My wife's laughing and shaking her head.
Sorry.
Did you lower your standards when you got married and end up with a
Absolutely.
rehab project?
I
Awesome.
made the better decision.
Very good. Any other questions?
You married up. Look at that. Obviously, yeah.
Don't we all? All right.
Anybody else? Any online? No? Oh, here's one. That's good. It's not sorry. That's what we're here for.
So before you got started, before you purchased, I know you said that you kind of went right out the gate and got with another couple and purchased a 54 unit. Before you did that, were you passively investing?
Great question.
No.
So you went straight into being an IRO right away with one other couple.
Can I ask one more question?
Okay, go ahead.
So you have 110 investors in this
Deal.
community.
Good.
Do you have any money in the game, or is it?
Absolutely.
Yes? Okay,
Yeah,
so you are an investor as well,
Absolutely.
as the lead.
Yeah,
Okay,
just
got
so
it.
you know, just really quick for new people, we make our lead investors have skin in the game. Who likes that? So, first time lead investors, I know the numbers are changing, but it was you'd have to put 15% of the capital raise. Who likes that we do that? Because we want to make sure they have skin in the game. They can't just walk away. So, yes, they do. They are required.
Yeah, and a lot of the lenders, they require it.
Yeah.
Whether, other syndicators tell you or not, the lender will require some sort of skin in the game.
And I don't care who, I'm sorry, am I still allowed to say that here? But if you're a passive investor investing with a lead or someone, if they're not putting a substantial amount of money, they don't believe in the damn deal. Don't do it, right? So if they're not putting anything in, or they're putting minimal amounts, I would consider twice whether you want to invest with them or not. They need to put a substantial amount in. If they think, if I'm doing a deal or he's doing a deal and they think they're going to kill it, how much money do you think they're going to put in? They're going to put in as much as they can, right? Or a lot of it, right? So that's when you need to get in with us.
Yeah, and it's going to be how much you have to invest. Some people have millions to invest. Some people only have 50 grand. So that 25 is what they can afford. You understand? So it's relative to you. What amount? What's my return for me? So it doesn't matter if it's 25, 50, 100 grand. That's a lot of money to you. You understand? So one of the rules I have for those of you who are going to invest in multifamily deals is I never put more money in than the lead himself put in. So the most I ever put in any one deal is like 400 grand, but I'm worth millions now. I wasn't when I started. No way I could put 400 grand. I put 25 grand in my first deal. So you see how it's relative as you grow as a person. Okay, great question. All right.
Any other questions? We got one back there.
Okay. You make me run all the way to the back. Dang. Exercise. Here you go.
Is there a stipulation as to how much money lead investors should put in each investment?
Yes.
There's a minimal.
Yeah, that's
within lifestyles, there's this
We have in lifestyles we have a deal. Like your first deal, we make the lead put in a substantial amount more. Second deal, a little bit less. Third deal, a little bit less. And that's because the deals typically go. If I do like $1 million my first time, I'll put in like 15%. If I'm doing like a $10 million a second, I'll put in 10%. If I'm doing a $25, $30 million, 5%. So it's all kind of relative.
We have rules on all this stuff, and it's written in
Right.
rules. If you don't follow the rules, what do?
Right.
We kick you out, just so you know.
We had a big meeting on that last night. Was it
Yeah.
for that?
Was anybody here at that meeting last night?
Yeah.
Yeah,
That was-
Dell actually taught that meeting. There was hundreds of people here last night. There were 600 people online. I was answering questions. So
Yeah, we left the bar like after midnight last
I
night.
figured that. That was the most important part. Yeah.
Crazy.
The meeting
Well,
was
we
2
learned,
hours.
We learned a lot over there, though.
Yeah,
I'm telling you.
the-
That's what you
The
learned.
meeting was 2 hours, but 4 hours at the bar.
Exactly.
Exactly.
Come join Life.
I don't drink, so you know what's awesome? I get to go to the bar with them all. They get drunk. I get out to Sharpie. I get to write on them.
Exactly.
All right.
Right on.
Anybody else? All right. Thank
Awesome.
you guys.
Thank you guys very
Appreciate
much.
it. Good job, man. Thanks, guys.